Hi all, good evening. My name is Aditya and I am actually at home and my internet seems to be acting up. That's why I switched off the video so that I don't use the bandwidth. Anyway, so very quickly, this masterclass is something that we do with all our advisor partners, and idea being very simple. Just one second. Yeah, idea being very simple of the masterclass that this profession requires trust for consumers and clients to trust us, right? And that trust is built upon our ability to explain things which are complicated for consumers to understand in a very simple way, right? Because ultimately people want their money to grow, right? And they were if they had the time and the energy to understand the subject themselves, then there would be no need for us, right? So we do this masterclass every alternate day, and it's people whoever are free attend, and hopefully there is something for you to take from this, and build your business. This is this knowledge sharing session, right? So I think today the subject that we're trying to cover is what's been happening in markets, and what does it mean for all of us, and when it comes to acquiring clients or advising clients, and what does it mean for and what does it mean? Are there any interesting ideas that we can use to advise clients as well as build the business, right? So the good news in equity market is this, that Sensex and Nifty have recovered. I mean, gained about 4.5% in last 1 month. But more importantly, since the big fall of March, we are back at 80% of what we lost. So if we lost, I mean, compared to previous highs, we are back at 80% of those levels, right? And there is this measure called VIX. It's called Nifty VIX. It's a measure of volatility, right? It has come down from 77 to 23.55, which means that, so VIX is actually often a reflection of the mood of people, right? Of the mood of traders, big investors, right? And in the mood suggests that we are currently from 77, which reflected, which is just like, high blood pressure has come down to 23.55, which means that overall things feel more stable. But the bad news is this, that earnings have fallen off, right? Ultimately, the price that we pay for a company or for a stock is a measure of is dependent on the earnings that that company can deliver, right? Ultimately, that's what drives the stock prices. But if you look at earnings, if you look at all the Nifty 50 companies and look at their earnings in April, May, June, they have fallen about 25%. So if they were making 100 rupees earlier, they are now just making 75 rupees, right? So which is a big fall, and it should, when if earnings are falling at that rate, then it should automatically result in market continuing to fall. But we haven't seen that, right? Market has continued to increase, and so what is the reason that market has continued to increase, right? One big reason is that there is more money available, which is called liquidity, right? And if you pay attention, and if that happens with us also all the time, right? That if I don't have money today, then I might be willing to sell my bike or my car or my house at a lower price just to need that money. But if I somehow get that money, then, and even if I want to sell, I will wait out for the right price, right? So that's what happens in liquidity, that if there is enough liquidity, then people will not sell at prices that are giving them big losses. They will hold selling off. So what happened in the US, and US is a big driver of all of this, because US continues to be the uh, largest economy in the world, and it continues to have the most money in the world, right? So banks across the world, the central banks across the world, printed a lot of money, and which meant that nobody was forced to sell at low prices, or nobody was forced to, like, I mean, to give you a very simple example, like there was a big company in the US, and it had about $1 billion of loan on which repayments were due in the March, right? And because of the crash, suddenly their incomes fell, so they could not pay the loans. So which meant that they had to refinance that loan of $1 billion, right? And investors at the same time were nervous that if I give this company $1 billion, what if they are not able to return it? But a simple announcement by US Federal Bank saying that I guarantee loans in all these sectors suddenly changed the sentiment, right? Suddenly US was saying that don't worry, whoever wants to give a loan to this company, please go ahead. I will back it up. I'll give the guarantee. And US government themselves actually give loan to a lot of companies. So that's what happens when you have liquidity. You are not, otherwise that company would have crashed and burned, right? Suddenly you how do you get $1 billion overnight, right? So that's what is meant by liquidity. Other thing that is driving, which actually is a big factor, is that in general across the world people look for safety right before returns. So the, the safest instrument that is considered to be across the world is US is buying debt of US government, which is called US Treasury, right? So basically giving loans to US government. And this is an $18 trillion market. 18 trillion, like it's hard to even count zeros at the end of it. I mean, in total, Indian economy is $2 trillion, right? And total, I mean, total debt of Indian government is less than, is just about $2 trillion. But US Treasury, which means that the loan paper issued by US equivalent of RBI is $18 trillion market. And if you give these guys a 1-year loan, they are going to give you just 0.12% as interest, right? Just imagine 0.12%. So that's what is happening, that the safest instrument in the world is giving nothing. In fact, if you buy 10-year instruments of US government bonds, they are right now trading at negative -1%. So you actually have to pay them for them to take your money, right? And same is the situation in Europe and Japan. And in India, we're also seeing that, right? FD was at 8% 3 years back. Now it's at 5.25. And RBI continues to say that we will probably not increase the interest rates and maybe reduce the interest rates further. So globally, interest rates are on a decline, and nobody is expecting interest rates to go up again in next 2 to 3 years time, right? So what happens now if I cannot give, if I cannot make money on one of the safest instrument in the world, then I end up saying that, okay, let me see what else is there. What else can I generate money on? And that's what a lot of money from there is actually coming into equities, is coming into gold, right? Is coming into, even startups, right? So that's what is happening. So primary two factors why equity markets continue to rise. One is that there is enough money in the market, like people are not short of money. Companies that were in trouble got money from somewhere else. US bank printed a lot of money, so that kept the money flow going, right? And second is the competing instrument, or the money where I could put safely and I earn some return. There, I'm not making any more money. In fact, we have some clients who have accounts in Swiss banks, and their Swiss banks are saying that we will charge you now to keep your money in the bank, right? So that's the situation today with debt, and that's what is driving actually equity markets to continue to rise, right? But obviously now three big questions come up, right? Three big questions come. That first question is that, is it still a good time to invest in SIPs or long term, right? That's always the question, that is it a good time, right? Everyone thinks that, oh, let me time it. And that's actually the biggest question always, whenever you speak to people, or even for yourself, if you're thinking about investing. Second question that comes, especially for clients that have bigger check sizes, people who want to invest more money, for them, the second question comes that, can I invest lump sum right now? If I have 50 lakhs, if I have a 50 lakh FD maturing, then is it a good time to invest in markets, right? Is it too expensive? Is the market already too expensive? And third question that comes is a crash around the corner, right? Is there a March like crash coming again soon? So these are three basic questions that come when it comes to equity markets. I will try and answer one by one, right? The first question, the answer is that over 5 years, equity will outperform everything else, right? And you can see there's some data in the table. So what I wanted to show was that if you look at, whenever in previous 10 years, Nifty gave less than 5, like for example, March, if you look at financial year 2002, 2003, 2004, in the last previous 10 years, Nifty had given -144%, right? But if you look at next 3, 5, and 10 years, returns are in upwards of 15%, right? So 14, 19, 17. If you look at after that, returns have been phenomenally good, right? It's only now that in March 2020, last 10-year return has again fallen below 5%. So that gives us a lot of comfort, saying that, even history suggests that equity will outperform everything else in next 3 to 5 years, right? So if you have a long-term horizon for investing, if you're doing SIPs in equity funds, there's no better time. There's no better time to answer the question whether timing is correct, right? The second question that we touched upon is that, is it still a good time to invest a large sum of money, right? So I think it's perhaps not the best time to put in a large amount of money in the markets, right? But there are some opportunities. For example, there are some sectoral opportunities. Like we have this Street Smart portfolio of funds, which has financial services, FMCG, and pharma sector funds, right? So these three sectors are actually, so bank and financial services actually went through a lot of pain, so they're undervalued, right? And FMCG is not affected by slowdown because of pandemic, because people continue to buy Maggie, or people continue to buy soap or shampoo, right? And pharma, of course, has been a beneficiary. So this is a great buy when you look at, if you look at deploying, say, lump sum amount right now, right? And this is something that is not more than, ideal holding period is not more than 2 to 3 years, because once you made some gains, so these are sectoral opportunities. They don't make, these are not things that you hold for more than 2 to 3 years, right? uh, then the second opportunity, of course, is in mid and small cap, because if we look at mid and small cap valuations, they are at 2013 levels today, as of today, right? And that is because of fear in people, right? People are fearful that small companies, can they manage the business, or should we look at, and that's why you see a lot of money coming into, in the US, a lot of money is going into big companies like Apple, Amazon, Google, Facebook. Similarly, in the US, like a lot of money given to Reliance, TCS, Infosys, right? But there are still a lot of good quality mid cap, small caps, which can generate superior returns if someone is looking at deploying a lump sum right now, right? And if someone is, of course, if someone is looking at a 50 lakh plus kind of check size, then there is a recommended PMS called 2.2 Capital, right? These are phenomenal guys. We can share more details about that. And then there are, of course, some funds which are well managed, mid and small cap funds, where deploying some lump sum could generate in reasonably good returns down the road, right? But I think it's, to answer the third question, that is it, is a crash around the corner? The data suggests that there is enough money out there, and moreover, the sentiment of people is also this, that a vaccine is definitely around in 6 months, right? So definitely, the position that being the position, there is lesser likelihood of market seeing a big correction again, right? But markets are as unpredictable as a dog walking on the street, right? You can't really predict. That is why it is always important to also hedge, with debt. And that's why we again always recommend that, of course, you should always get the equity debt mix right for a client. But especially if you look at debt, there are reasonably good opportunities where one can generate much higher returns than FD for sure, and even probably comparable to equity in the next 3 years. So this debt is a combination of some medium and long duration funds, right? And if I look at its returns, last 1 year it has given 11.3%. Last 3 months it's given 5%. So if I analyze it, it's actually a 20% in a year, right? And one advantage that this portfolio gets, it's a high quality debt portfolio, so it does not have any issues like Franklin had. But secondly, as when the interest rates fall, if RBI again announces a rate cut, automatically there is an immediate advantage in the returns you get in a debt fund, right? So that's all I had to share in today's masterclass. And I believe that I was able to answer two important questions. One is around, why is equity market rising? Second is, is it still a good time to invest? And third, of course, around that, if it's a good time to invest, then where can I park the money, right? We can share these pages with you if you want to study them further. If you have any questions, I can answer maybe two questions. You can type it out in the chat, right? And even if you have questions after this, you want to message your relationship manager, please do, so that we can answer it separately as well. But yeah, a couple of questions I can answer. If you have, please type in the chat. I guess there are no questions. Yeah, Gaurav is saying, please share it with us. Of course, we'll share with you. So Sombir has just joined. Sombir, we are almost done. Actually, it's a 15-minute session. But if you want, I mean, we can share this document with you. And but yeah, broadly, Sombir, we covered two things. One is that why are equity markets continuing to rise, right? And answer is in two things. One is liquidity, and second is that liquidity means that there's enough cash out there, and second is that usually wherever people used to deploy cash, that especially in the US, was in debt market, US debt market, that is giving low returns. So a lot of money is coming back into equities because of that. Second question was that it's still a good time. Of course, it's a good time because if you look at historical data, then and you can see this data. We will share this document with you. Then there are enough opportunities still. Like for example, SIPs is a great. Still continue to be a great investment. They will next 5 years it will definitely beat. You'll be able to generate 14 to 15% IRR comfortably. Right? If you continue doing SIPs for next 5 years and start today. Right. Second is, of course, there are some sectoral opportunities which are through our street smart portfolio. And third is there is sizable, very good opportunity actually in good mid and small cap. At the same time, it's one can also hedge portfolio with debt funds, and there is again a debt portfolio which has given like 11% last 1 year, and it will very easily beat FD for next 3 years and probably continue to generate 10 to 11% kind of returns in the next 3 year horizon. So thank you everyone. We'll share this document and hope to connect again soon. Bye.